If you're over 60, there are three financial warnings moving through the retirement system right now that could quietly cost you thousands of dollars, even if you've worked hard, saved responsibly, and followed all the rules. I'm not talking about stock market crashes or risky investments. I'm talking about hidden government rules, healthcare costs, and tax traps that many retirees don't discover until the damage is already done. In today's video, we're going to uncover three specific threats that could shrink your retirement income in 2026, a Medicare premium trap that can eat away all your Social Security increase, a healthcare cliff that could leave early retirees paying thousands more for coverage, and a little-known tax rule that can trigger a surprisingly large tax bill on your benefits. Most importantly, I'll show you the practical steps many seniors are using to protect themselves. Make sure you stay with me until the end, because each warning comes with a strategy that could help safeguard your retirement and your family's future. The challenge facing many retirees today isn't just rising prices. It's something much harder to see. It's the growing gap between the retirement plan you built over decades and the rules that now govern how that money is taxed, distributed, and protected. Many Americans spent 40 years doing exactly what they were told to do. They worked hard. They contributed to retirement accounts. They delayed gratification. They paid off debt. They followed the advice of financial experts and government agencies. But retirement in 2026 is not operating under the same rules that existed 10 or 20 years ago. The danger isn't usually one catastrophic mistake. The danger is a series of small financial leaks that quietly drain thousands of dollars from retirement income every year. One retiree loses money because a Medicare surcharge unexpectedly appears. Another triggers higher taxes simply by taking money from an IRA. Someone else discovers that a healthcare subsidy vanished because their income crossed a threshold by a surprisingly small amount. These aren't investment failures. They're system failures. And unfortunately, most retirees don't discover them until after the damage has already been done. What makes these issues so dangerous is that they often operate behind the scenes. Your Social Security benefit interacts with Medicare. Your Medicare premiums interact with your taxable income. Your retirement account withdrawals interact with your tax bill. Your healthcare costs interact with government eligibility rules. Everything is connected. And if you're still using the retirement playbook that worked 10 years ago, you may be exposing yourself to risks that simply didn't exist before. That's why I want to focus on three specific warning signs that deserve your attention right now. The first warning is what I call the Medicare premium cliff. Most retirees assume Medicare premiums are the same for everyone. They aren't. Many seniors are surprised to learn that Medicare uses something called IRMAA, which stands for Income-Related Monthly Adjustment Amount. This is essentially a surcharge that can dramatically increase what you pay for Medicare Part B and Part D. And here's where it becomes dangerous. The government doesn't just look at your current income. Instead, Medicare uses a 2-year look-back period. That means your 2026 premiums can be affected by income reported years earlier. Maybe you sold a property. Maybe you took a larger IRA withdrawal. Maybe you converted money to a Roth account. Maybe you received a one-time payout. Any of those events could potentially push your income above a Medicare threshold. The result? Higher monthly premiums. And in some cases, crossing a threshold by a relatively small amount can trigger a much larger annual cost than retirees expect. This is why one of the smartest moves you can make is scheduling a review with a qualified tax professional before making major retirement account withdrawals. Ask specifically about Roth conversions. Ask about strategies for managing taxable income. Ask whether future withdrawals could trigger an IRMAA surcharge. The goal isn't avoiding taxes forever. The goal is preventing unnecessary premium increases that quietly reduce your retirement income year after year. The second warning is something I call the Social Security point of no return. Every year, millions of Americans ask the same question. Should I claim Social Security now? Or should I wait? Unfortunately, many people make this decision based on what worked for a friend, a neighbor, or a family member. But retirement decisions should never be based on somebody else's circumstances. Your health is different. Your family history is different. Your tax situation is different. Your spouse's needs are different. That's why one of the most important tools available to retirees is something called a break-even analysis. Instead of focusing only on getting checks as soon as possible, a break-even analysis compares the long-term value of claiming early versus delaying benefits. For some retirees, claiming early may absolutely make sense. For others, waiting can produce substantially larger lifetime benefits. And for married couples, the decision can have an even greater impact because of survivor benefits. A larger benefit today could potentially become a larger survivor benefit later. That's why I encourage every viewer to pull up their Social Security statement and study the numbers carefully. Don't assume. Verify. Look at what your benefit would be at your current age. Look at your projected benefit at full retirement age. Then compare it to the projected benefit at age 70. The difference can be larger than many people realize. The key lesson here is simple. A claiming decision is not just about this year. It's about protecting income for the next 20 or 30 years. The third warning may be the most overlooked of all. It's what I call the inflation lag problem. Many retirees build budgets based on historical assumptions. They assume savings accounts will always provide enough flexibility. They assume annual adjustments will keep pace with rising costs. They assume their purchasing power will remain relatively stable. But recent years have exposed a different reality. Healthcare costs can rise faster than benefit increases. Insurance costs can increase faster than inflation adjustments. Essential expenses can climb long before income catches up. That's why retirement planning today requires a shift in mindset. The conversation is no longer just about saving money. It's about income protection. The question isn't simply, how much do I have? The question is, how much of my essential lifestyle is protected if costs rise unexpectedly? Many retirement experts now encourage retirees to evaluate the balance between liquidity, stability, and growth. In other words, how much of your portfolio is designed to generate dependable income during difficult periods? How much is available for emergencies? How much is exposed to market volatility? Some retirees use TIPS, or Treasury inflation-protected securities. Others explore high-quality annuity strategies. Others build cash reserves specifically for periods when inflation temporarily outpaces benefit increases. The exact solution will vary from person to person, but the principle remains the same. Your retirement plan should not depend entirely on perfect market conditions. It should be built to withstand uncertainty, because retirement security isn't created by predicting the future. It's created by preparing for multiple outcomes before they happen. When you step back and look at these three warnings together, a clear pattern begins to emerge. The biggest threats to retirement today are often hidden in plain sight. They're buried inside premium formulas. They're buried inside claiming decisions. They're buried inside inflation assumptions that no longer reflect reality. And that's exactly why awareness matters. If this information helped you understand the hidden traps that can affect your retirement, leave a comment below and tell me which one surprised you the most. Share this video with someone who is preparing for retirement, because a conversation today could prevent a costly mistake tomorrow. And make sure you subscribe to this channel for more retirement protection strategies designed to help you protect the money you worked a lifetime to build. The sooner you identify these pressure points, the more options you have to protect what you've spent a lifetime building.